Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Qorvo Inc. quarterly report. Qorvo Inc. offers a diverse range of technologies and products for various markets. The company operates in three main segments: High-Performance Analog, HPA, Connectivity and Sensors Group, CSG, and Advanced Cellular Group, ACG. The HPA segment provides radio frequency and power management solutions for defense and aerospace industries, as well as 5G and 6G infrastructure markets. On the other hand, the CSG segment offers connectivity and sensor solutions featuring various technologies such as UWB, Matter, Bluetooth Low Energy, and Wi-Fi. These solutions cater to smart home, industrial automation, automotive, smartphones, wearables, gaming, and industrial and enterprise access points markets. The ACG segment supplies cellular RF solutions for a wide range of devices including smartphones, laptops, tablets, and various other electronic gadgets. Additionally, the company offers foundry services for defense primes and other defense and aerospace customers. Qorvo's products are sold directly to original equipment manufacturers and original design manufacturers through its network of sales representative firms and distributors. In summary, Qorvo provides a variety of businesses and services including radio frequency and power management solutions, connectivity and sensor solutions, UWB, Matter, Bluetooth Low Energy, Wi-Fi, cellular RF solutions for various devices, foundry services for defense primes and other customers, sales to original equipment manufacturers and original design manufacturers through its network of sales representative firms and distributors. Qorvo Inc.'s stock price drop. A year in review. In the past year, Qorvo Inc. Qorvo has experienced a notable stock price drop of over 7.81%. The primary cause of this decline was the company's disappointing fiscal fourth quarter 2026 guidance and subsequent analyst downgrades. The most significant event contributing to this decline occurred on January 27-28, 2026, when Qorvo issued its financial outlook for the fiscal fourth quarter ending March 2026. The company projected revenue between $775 million and $825 million, which fell short of Wall Street's consensus forecast of approximately $905.1 million. Several factors contributed to this weaker outlook, including a seasonal decline in demand from its largest customer, Apple, an ongoing effort to reduce exposure to the lower-margin Android smartphone business, and the impact of rising memory prices on smartphone manufacturers' build plans. The weak guidance led to a substantial decline in Qorvo's stock, with shares plummeting 9–10% in pre-market and extended trading sessions. Coinciding with this weak outlook, several investment firms revised their ratings and price targets for Qorvo, further contributing to the negative sentiment surrounding the stock. While Qorvo reported strong fiscal third-quarter results that surpassed analyst expectations, the significantly weaker guidance for the subsequent quarter was the primary driver behind the stock's recent decline. Qorvo Inc. market capitalization of $7 billion is materially smaller than most of its industry peers of roughly $27 billion. Qorvo Inc. trades at a lower price-to-earnings ratio of 21 times and a lower price-to-book ratio of 1.93 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 43% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the key statistics and trends presented in the summary. Revenue growth was driven by several factors, including an overall increase of $76.6 million from Q4 2024 to Q4 2025, representing an 8.4% growth rate. Within this growth, the United States market saw a notable increase of 10.3%, while the HPA segment experienced a significant boost of 11.3%. Additionally, increased content in flagship and premium tiers of smartphones, higher demand for infrastructure products, and expanded programs in defense and aerospace all contributed to revenue growth. On the other hand, revenue decline was primarily attributed to decreases in China and Europe markets, with declines of 13.4% and 5.5%, respectively. The CSG segment also saw a decline of 1.8%. Furthermore, strategic decisions to reduce exposure in mass-market Android smartphones and decreased revenue for Wi-Fi components contributed to the overall decline in revenue. Net income experienced significant growth in 2025 compared to the previous year. In Q4 2025, net income reached $164,062, a substantial increase from $41,271 in Q4 2024. This trend continued throughout the year, with YTD 2025 net income rising to $309,259 from $24,250 in YTD 2024. The improvement in net income can be attributed to various factors, including changes in operating expenses and variations in revenue growth. Additionally, the impairment of goodwill and intangible assets contributed to the increase in net income. Profit margins also saw a notable rise in 2025. The gross profit margin increased from 42.7% in Q4 2024 to 46.8% in Q4 2025, while operating income margin rose from 5.8% to 19.4%. These improvements can be attributed to reduced exposure to lower-margin products and a favorable business mix. The increase in profit margins is also linked to improved product costs and restructuring initiatives. However, the latter resulted in increased restructuring charges, which may have had a temporary negative impact on net income. Overall, the changes in operating expenses, revenue growth, and impairment of goodwill and intangible assets played significant roles in shaping the company's financial performance in 2025. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 2 years. As per the provided information, the net cash provided by operating activities has been steadily increasing, with notable figures including $532,367 for the 9 months ended December 27, 2025, and $423,000 for the same period in 2024. A significant milestone was reached on December 27, 2025, when the company achieved a positive operating cash flow of $1,318,510. Furthermore, in Q3 FY 2026, the net cash provided by operating activities surged to $265.4 million, demonstrating the company's ability to generate substantial cash from its core operations. These figures collectively suggest that the company is successfully generating positive operating cash flow, indicating a strong financial position and a healthy cash generation capability. The company's debt level and interest expenses have undergone significant changes over the past year. While long-term debt has remained relatively stable, total liabilities have decreased by $75,148 from $2,540,819 in 2024 to $2,465,671 in 2025. This reduction is largely due to a decrease in accrued restructuring balance, which dropped by $1,742,000. In terms of interest expenses, the company has seen a slight decrease from -$18,655 in 2024 to -$18,024 in 2025. This represents a decrease of 2.1% for the 3 months ended and 5.6% for the 9 months ended. The actual dollar amount of interest expenses also decreased by $631,000 for the 3 months ended and $3,049,000 for the 9 months ended. These changes indicate that the company has made efforts to reduce its debt burden and lower its interest expenses. Management is optimistic about the company's outlook, citing strong performance from its 3 operating segments. These segments are leveraging their technologies and products to serve various markets effectively. The company has sufficient liquidity to meet both short-term and long-term cash requirements, but may seek additional financing if necessary, which could potentially dilute common stockholders' value. Acquisitions and divestitures are significant strategic decisions made by companies to expand or restructure their operations. In terms of acquisitions, the company has engaged in several mergers and partnerships. One notable example is the merger with Skyworks, which likely aimed to enhance the company's capabilities and competitiveness in the market. The company has also acquired various businesses, including a MEMS-based sensing solutions business, which was sold by another entity. Additionally, the production of surface acoustic wave filters was transferred from North Carolina to Texas, indicating an effort to optimize operations and improve efficiency. On the other hand, divestitures refer to the sale or disposal of certain assets or businesses. The company has made strategic decisions to reduce its exposure to mass-market Android smartphones, which may have been driven by market trends or competitive pressures. This move is likely aimed at focusing on more profitable segments and reducing operational costs. Furthermore, the company has sold several businesses, including a MEMS-based sensing solutions business, resulting in a significant gain of $19.2 million. The sale of the silicon carbide (SiC) power device business was another notable divestiture, which may have been driven by changing market conditions or shifting priorities. Finally, the company has also sold product lines with less than $100 million in annual revenue, indicating an effort to streamline its operations and concentrate on more profitable areas. The company's financial activities have been focused on share repurchases in recent years. According to the provided information, the company was authorized to buy back up to $2 billion worth of shares. In 2024 and 2025, the company took advantage of this authorization by purchasing a significant number of shares. In 2024, the company bought back approximately 3.3 million shares, while in 2025, it repurchased around 1.6 million shares for about $132.7 million. These transactions demonstrate that the company has indeed been actively buying back its own shares, rather than paying dividends to shareholders. There are concerns about inventory buildup and supply chain disruption. The data suggests that total inventories have increased significantly from $530,178,000 to $640,992,000 over a certain period. This increase is indicative of a potential issue in the company's inventory management. Furthermore, financing costs related to inventory and share repurchases are also a cause for concern. These costs may be indicative of inventory buildup or supply chain disruption, which can have significant financial implications for the company. Additionally, there are increased risks and costs associated with the timing of customers' forecasts and underutilization of manufacturing facilities. The issue is further compounded by the fact that the company has repurchased inventory in connection with a supply agreement, indicating potential inventory buildup. This suggests that the company may be struggling to manage its inventory levels effectively, which can lead to supply chain disruptions and other issues. Overall, these concerns highlight the need for the company to reassess its inventory management strategies and address any underlying issues to prevent further complications. That concludes the financial summary for Qorvo, Inc. Feel free to comment below, and I will be happy to answer them when possible.